General market questions to begin with, and I guess the Fed minutes today might be added interest for your view on this. But the biggest risk to markets is what, and what sort of time frame are we talking about in terms of when it might lead to a bigger pullback?
Yeah, I mean, I think the number 1, 2, and 3 concerns in the market are inflation, inflation, and inflation. And that's pretty much what you have to be focused on, because with valuations sitting at record levels, if the Fed is forced to do something it doesn't want to do, like taper before the end of this year, that's going to have a really big impact on equity market multiples. And we actually tweeted out something on that this morning where we were looking at the 1970s. We said, history may not repeat, but it often rhymes, which is a famous Mark Twain quote. And if you look at that chart, which you hopefully have, what you can see is that even though you had 50% earnings growth between 1972 and 1974, because inflation was really picking up, you had the stock market from peak to trough drop close to 50%, despite 50% earnings growth, and that was driven by inflation. Today, you're starting with trailing PE multiples sitting at 30 times, not 20 times. And so the risk to the downside, if something goes wrong, and they're wrong, and it's not transitory, which I don't believe it is, that's going to cause much bigger issues given the levels we're starting at for valuations.
But I guess the pushback on that, Dan, would be to what extent is some tapering by the end of the year already basically expected by investors? We're not talking about 3 rate hikes by the fall.
Well, you don't have any idea. I mean, right now you've got CPI. The month-to-month increase in CPI was the fastest since 1982, and that number is sitting at 3% year over year. We haven't even fully reopened yet. I haven't been on an airplane since I was out to sit with you and Sarah in January of last year. I just got my second vaccine shot 2 weeks ago. My kids got it last week. We're sitting here going, okay, where are we going to go? And that's going to increase demand for oil as factories open up, as well as people start going places. And so you're going to see demand surge. At the same time, you've had an underinvestment in capacity, arguably for the last decade, because it's been the slowest recovery since a recession, since World War II. We averaged 2.3% GDP growth from 2010 to 2019. So all of those things come together into whether you think inflation is transitory or it's going to be more persistent. And for those reasons of underinvestment combined with the best GDP growth of the global economy this year at 6% since the 1970s, I think you're going to see a much bigger inflation problem than the Fed is counting.
Shepard Smith here. Thanks for watching CNBC on YouTube.